What is going on, investors? Hopefully guys are doing well out there. That is right. It is Friday. I believe it's a 3-day weekend, and that means it's time for the FAANG Stock Recap Show. We're here on the Investor Channel. Every Friday, we recap all the major news of the week and the technical chart patterns from all the major FAANG stocks, including Microsoft, Tesla, Netflix, NVIDIA, and more. We'll talk about the first stock we always do, and that is Meta Platforms, otherwise known as Facebook. They changed their ticker last week to Meta. This stock started the week closer to $171 per share, and in the week at $163.85. That's about a 5% decline on Meta this week. We'll see that from a technical perspective. Now, Meta is facing a lawsuit claiming medical data leaked to Facebook. This is in relation to a pixel tool that Facebook gives to web developers to put on their websites to allow essentially Facebook to kind of monitor a bunch of data about your website. And it looks like this tool was not properly installed on these hospital website and patient portals, and that caused some medical data to flow into Facebook's grasp, and they're certainly going to get in trouble with that. Now, Apple's WWDC, which is the Worldwide Developer Conference, had some privacy changes that were basically unseen by Wall Street, but it is viewed as a slight positive by Meta and Snap. Now, we won't get into the minutia about what Apple changed this week or kind of rolling out in their next operating system, but it looks like they just kind of tweak things just a little bit that might make it just marginally easier for Meta to get some data on whoever is kind of using their apps and using their services to maybe show them a slightly more relevant ads. This isn't a major overhaul or a major change, might just slightly incrementally help Meta, but that's good. It's not going in even a further direction down the road where it could hurt Meta even more. In fact, Meta's ad pricing challenges are seen as easing up by Piper Sandler. This is suggesting that some of the company's headwinds related to their advertising products are starting to moderate a little bit. Obviously, Meta is facing kind of a double whammy. They had the iOS changes, which basically wiped out a lot of the targeting that they were able to do and was incredibly effective for not only Facebook to make money, but the advertisers that were using the platform. That got rolled back last year. And at the same time, we're seeing increased competition from websites and apps like TikTok, which are far more revolving around kind of short form video. Obviously, Facebook and Meta and Instagram has a platform for that and has the ability to do that, but it takes a little while for advertisers and kind of the advertising product to kind of catch up to where the consumers go. So Meta is kind of in a transformative period when it comes to that. And analysts are starting to say, well, maybe we're starting to get to the other side. We'll see about that. Now, Meta challenges the UK's block of the Jiffy deal, and their efforts to do that mainly fell short. Now, this is a GIF search engine, which kind of puts all these GIFs or GIFs or however you want to say it in a database, allows you to search for them. Regulators are concerned that maybe these will not be allowed to be used on other social sites other than Facebook and Instagram. This was a $400 million deal back in 2020. It looks like it's just caught up in the courts. And this is just kind of a broader argument how difficult it is for these companies to make even a relatively small acquisitions like this that just adds another layer of support onto its products. It's hard to get these deals done themselves. Quite frankly, Facebook could have just paid some of their employees to get this database together, how much this is costing them in terms of legal fees. Moving on to Apple, started the week at 133, ended down like most of these stocks, down to $131 per share. Now, Apple's brand value races towards $1 trillion, even as its market cap dips closer to $2 trillion. Cantor essentially valuing Apple's brand at $1 trillion. Now, obviously, as an investor, that makes you feel warm and fuzzy inside, but it doesn't really translate to anything tangible that us as investors can really touch, okay? Could Apple borrow against their $1 trillion value in their brand? Could they do that? Maybe. Could they sell the entire brand? They probably could do that, but obviously you'd lose some things. So while their brand is worth $1 trillion and it's great, some of that is factored into the market cap. It's the brand that generates the sales and the loyalty, quite frankly, with Apple. Now, we did talk about how Apple is falling near that $2 trillion valuation as we're seeing this company just continue continue to shed its market cap. It was up over $3 trillion just a couple of months ago. Now, Taiwan Semiconductor, which is TSM, is to start 2 nanometer chip production by 2025. Now, the race is on. Samsung apparently has a 2 nanometer or maybe even a 3 nanometer process. Intel claims they have a 1.8 nanometer process by 2025, although Intel says a lot of things and then they don't end up delivering. But this is critical to Apple because TSM is their primary chip supplier and chip maker for them. And so these chips theoretically could make their way into computers and phones. And obviously TSM has a strong track record at delivering on this. And if they can somehow deliver before Samsung and Intel, would give a huge competitive advantage to Apple, which is seen as one of its largest customers. Apple is working on an entry-level iPad with USB-C connectivity. Obviously, we talked about how last week there was an EU ruling saying that Apple has to switch to USB-C connectivity. They can't use their own proprietary connection to charge and kind of link up their phones and their devices. My guess is you'll see that roll out kind of nationwide or worldwide with Apple. But now I think what we're seeing with Apple's kind of announcements on their products last week at WWDC, I think what we're seeing with Apple is they're trying to hit all price points. So they're trying to come underneath some of their low price points now, but they're also going to push it to the high end, their Pro and their Pro Max chips that are going into some of these iMacs and the MacBook Pros. Okay, they're trying to get $4, $5, $6, $10,000 or more for their really high end PCs and MacBooks, but they're also trying to hit kind of that underneath price point, underneath where they already are. I think that's a great strategy by Apple, have kind of a good, better, best. Now, this was also a big story, a major story, which I think will parlay into other sports rights. The MLS signed a landmark 10-year deal with Apple. Every team in the MLS, there are no carve-outs. There are no teams that are not going to be included. That means every single Major League Soccer game that is televised will go through Apple, which has a 100% exclusive license. Now, that does not mean that ESPN and other networks won't be able to show certain games, maybe the championship game, playoffs, maybe a big game in the league. ESPN and these other networks can negotiate that type of airing, but Apple will still be able to air that game on their own platform. And in this case, it appears what they're going to do is create a new Major League Soccer app inside Apple TV where you'll be able to subscribe to this and watch every single MLS game you can possibly want to watch. This deal stretches out over 10 years. It's guaranteed to be worth $250 million a year. Typically, how these league licenses work is a company like Apple comes in and then offers a minimum amount every year. This is the same with the NFL. This is the same with the jersey contracts, the trading card contracts, the TV contracts. Typically, you offer up a major amount of money every year. In this case, it's slightly unique because in the past, typically companies offered up just a rights fee for the package. In this case, Apple is offering up a guarantee worth $250 million a year, but there's upside for the MLS because Apple is going to create this new Major League Soccer app, which will cost, I don't know, I would assume anywhere from $19.99 to $25 a month or something like that, to where you can watch all the games. Well, the MLS is also going to make money off of that as well. This type of deal is the future of the NFL deal, the MLB deals to come. It's essentially going to be a partnership with one of these big tech companies. Well, they'll pay a minimum amount per year. They'll also create another form of revenue. Quite frankly, this is the next layer of competitive advantage for companies like Amazon, but particularly Apple as well, as they have so much cash. $250 million a year is a fortune to 99.9% of companies out there. And the 0.1 where it's just pennies is Apple. And this is going to ink and solidify Apple in the sports licensing and the sports televised market. And I think this will be a tremendous growth driver for Apple in the years to come. It will take a while, though, for that to kind of trickle down and show itself to investors. There'll need to be some patience there. Moving on to Amazon, start of the week at 105, ended up just kind of marginally up to closer to $106 per share. This is after Amazon lost a court battle over whether consumers can sue over lack of toxic warnings. There's this Prop 65 that was passed out here in California where basically every product that you buy out here in California has like a label on it saying you can get cancer. Now, I'm kidding a little bit, but it seems like you see this warning all the time. It's just another example of red tape out here in California that creates a lot of packaging and obviously lawsuit opportunities for consumers that want to be warned about every little thing that they buy. Amazon will not be shielded by those protections. They will likely continue to get sued on stuff like that. Amazon Prime Day to be held on July 12th and July 13th. That's less than a month away. I actually am optimistic about Prime Day this year, whereas in years past, not as optimistic about how it will impact Amazon sales. That's because over the past 2 years, the consumer has been really flush with cash, has been staying at home, has been buying every little thing that they've wanted on Amazon or Target or whatever website it is. Well, now we've kind of gone through about a 6 to 12 month period where a lot of people are traveling a little bit more. They're not really staying at home as much as they were. They maybe haven't been buying the kind of latest consumer electronic device that they've wanted. They've spent that money in other places. The other thing that we're seeing is this big talk of there's a recession. Obviously, gas is $7, $8. Well, an event like Prime Day, where it's like, hey, I can actually shop on this day. I can save some money. Maybe I'll be able to find a fantastic deal. I think consumers are going to be more willing to do that. Now, are they going to have as much money to spend this year as opposed to last year or the year before? No, probably not, because you don't have stimulus checks and PPP loans flushing the system with money. But I think this is a relatively good time for this event. And I think Amazon, as every year, they have great results with it, but I think you'll have a more eager consumer to kind of check out the deals this year. Now, Amazon AWS spending looks durable. This is according to Morgan Stanley. We obviously saw this when Oracle reported, I believe it was either earlier this week or late last week. They produced outstanding results. So you figure if Oracle is seeing fantastic results, that's probably going to parlay into Amazon's AWS and certainly Microsoft and Google as well. Those should be interesting. We're a little over a month away from Amazon earnings as well. Amazon is finally ready for Prime Air drone deliveries. And this is what's been missing with Amazon, I think, over the last 2 or 3 years. This company used to announce really exciting kind of innovations, whether it was AWS, many years ago, or seller fulfilled stuff, or their warehouses, or their delivery network. This company was one of the first to kind of like say, hey, we're going to deliver packages by drones. And it looks like they're actually going to start doing this in Lockford, California, which isn't far from me. And I played many of high school matches on a golf course that was called Lockford Springs. I don't believe it exists anymore. I'd love to head up to Lockford here, maybe in the coming weeks, and see if I can't see one of these drones flying around. According to Amazon, this will be a place where customers will be able to place an order as they normally would, but they'll also see certain items that will have a drone delivery. And for these deliveries, the drone will fly to a designated delivery location and descend into the customer's backyard, hover at a safe height, and then release a package and rise back up to altitude and I guess go back to Amazon's warehouse. I think this will be fascinating. If this company continues to push into this area, I think this opens up so many opportunities for Amazon that I'm very excited about that. Moving on to Netflix, start of the week at 176, basically flat. End of the week closer to about 175. Netflix shares rose during the midweek, and then obviously we had that big sell-off, and then everything ended, at least in this group, slightly down a little bit or basically flat. Netflix saw its shares rise as Cowen sees heavy advertising upside. I'm agreeing with this. I'm jumping on board here. I think the only question is how Netflix is going to execute that, how long it's going to take, and how much CapEx is it's going to require them to get this up to speed. I have another news story here that kind of relates to that, in the fact that Netflix is in talks with Roku and Comcast about helping its move into ads. And so I think that looks looks like, just on the surface, reading these press releases, that looks like the direction that Netflix wants to go. They don't want to hire a bunch of engineers and create this kind of self-service ad product. They want to go to Comcast, which partners with a lot of other people to show relevant ads. They want to partner maybe with a Roku, maybe even buy Roku to get access to that technology, kind of accelerate their move into this. And so I tell you what, if they're able to do this via some kind of partnership, or they'll be able to kind of acqui-hire or make acquisitions in that online kind of ad streaming space, well, I tell you what, got a huge opportunity, I think, with Netflix. If they're able to scale up an ad business with not a ton of CapEx and maybe start squeezing those gross margins kind of right away off those ads, well, that will be a fantastic business. Now, Netflix is ordering Squid Game reality competition show. This is on the heels of announcing Squid Game, I think season 2, or just the next iteration of this. These are not shows that I particularly watch, but I saw a ton of people talk about this. It was streamed over 1.6 billion viewing hours, not 1.6 billion minutes, 1.6 billion hours of people spending and watching this. I tell you what, when Netflix finds a winner, I'd love for them to just squeeze it even harder, okay? Get a reality show, make a spin-off, just expand the brand just really wide, why people obviously are excited about it. Moving on to NVIDIA, start of the week closer to 161. This one dipped down below 160, and I'll tell you on the technical segment, if I stepped in on NVIDIA, this one ended the week just south of $159 per share, down about 1.7%. Now, NVIDIA's China highlights its partnership with NIO. I tell you what, if you're bullish on NIO, you probably should be bullish on NVIDIA as well, as they are partnering on to develop like AI powered and kind of software defined cars. Obviously, you need mega chips inside these cars, and we see AMD, I believe they're partnering with Tesla, NVIDIA working with NIO. Now, somebody that's not really excited about maybe what's going on with that is NVIDIA's director sold nearly $36 million worth of common stock. That obviously is just a massive amount. You never are super concerned. When I see directors cash out a couple $1,000,000, it's like, okay, these people usually live out here in California where, yeah, you've got to have millions of dollars if you want to live kind of that CEO or that executive lifestyle out here in California. Tell you what, 36 million. Well, it's not putting you in the richest of rich out here in California. You are doing really, really comfortably after you pay all your taxes on that. No doubt about that. Moving on to Google, start of the week at 2,151, basically flat. End of the week at $2,145 per share. This will probably lead our stories next week as Google's CEO is heading to Capitol Hill to meet with lawmakers as antitrust calls heat up. So we've got a couple bills, I think, floating around in the Senate and the House, and they're bipartisan, okay? You have some Republicans that are on board, and you have some Democrats on board. So, but what we are seeing are all the lobbying efforts right now. The CEOs are going to go to Capitol Hill. We're going to see so much palm greasing over the next couple of weeks from the likes of Google, from the likes of Facebook, from Apple. They are going to go grease the palms of these politicians, likely getting them to the finish line of passing something. But that what I would believe the goal that these CEOs have, and some of you could argue with me, but the goal of what these CEOs should do is go there and have Congress pass laws that put such a barrier for entry when it comes to data sharing, privacy protection, security, all those types of things, where you basically have to be a multi-billion-dollar company with not only the technology, but the legal team behind you to afford the compliance behind all these new laws and regulations that are going to come by that only Google, Facebook, Apple, Amazon, these are the only companies that are going to have the infrastructure and the money and the legal team to handle the compliance, to keep up with all the regulations and not run afoul with any of the regulators, because guess what? They're all running to Capitol Hill to go write this bill that, in my opinion, will probably solidify their market share and make it more and more and more difficult for upstarts to come up and challenge their business model. That's just my opinion, but that's typically how it works in Washington when it comes to mega cap businesses. Google offers allowing rival ads on YouTube in an EU concession. This is basically EU antitrust investigation that has a problem with Google. The fact that in order to show ads on YouTube, you have to use Google Ads Manager. The same thing. If you want to show ads on Google search engine, you have to use Google's proprietary auction system, which you have no transparency over, and you have no visibility into whether or not you are getting ripped off. And on top of that, they make automatic changes. So you might be bidding 15 cents one day, but the next day or another time of day, you might be bidding 19 cents, 25 cents. Obviously, you have control over this as an advertiser, but I tell you what, very, very little transparency. And this would be very, very much amazing if Google had to open source their advertising. It would just open up such a big world. I don't think it would be a negative at all for Google, and certainly for creators like me that rely on a little bit of ad money every once in a while. Well, probably would put a little money in my pocket as well. Now, there is a senior Google engineering claiming that an AI chatbot system is sentient. I think I said that right, but I had to go look up sentient because I didn't know the definition of it, but it basically means something that has feelings, something that can kind of feel and perceive things on their own, which really you start seeing almost when your kids are first born, but you really start to realize at 3, 4, 5, 6 years old that they have this human nature just to feel things. And this Google engineer, which I believe I think he ended up being fired, but he says that they have these AI chatbots, which basically either are so well trained that they seem like they have feelings and are like human-like, or that they actually do have feelings. And I don't know. I've played around with chatbots and played around with AI enough to know if you stuff it with a ton of information, it can be incredibly realistic. This to me is incredibly bullish for Google, because if their engineers are fooled or at least floating this out there, I think it means incredibly great innovation in the future. These types of things are inflation killers. Instead of having somebody at a call center, instead of having a huge support team, well, all of a sudden you can support it with these chatbots, which people are not sure if are human-like or they're not. That certainly can replace an expensive workforce, drive down cost, and that ultimately is an inflation fighter. Moving on to Microsoft, started the week at $246 per share, ended up just slightly to about $247 per share. Microsoft is to focus on the 3 C's when it comes to their video game industry strategy, and that is community, content, and their cloud platform offerings. We obviously saw it with content when they made a $69 billion acquisition offer for Activision Blizzard. We're seeing them expand community and those types of things. I think that's just something that they throw in there. They don't have a market leading platform when it comes to that, especially when you look at something like Twitch, but they also have a leading cloud offering. We saw last week they partnered with Samsung to offer essentially an Xbox streaming service where you don't even have to have an Xbox, just a controller and a specific Samsung TV, and you're going to be able to play video games via the cloud. Now, Microsoft is testing casual gameplay within their Teams offering, so you might be able to play solitaire inside Teams. This is mildly interesting. I just think this is a product that will continue to gain kind of ubiquity across the business world, even though maybe Zoom is better, maybe FaceTime is better, maybe Oracle's product or Cisco's product, like WebEx, is better. I just think Microsoft will just throw so much money behind this that it will always be there and always capture a certain portion of the market share. Now, Microsoft rose this week as it acquires a cybersecurity company called Miburo. Now, this is one of these other small, quote, smaller acquisitions, probably tens of millions of dollars, or in some case, hundreds of millions of dollars for these small companies. You won't recognize it on the revenue. You won't recognize it on the expense, but these types of acquisitions, especially in this environment, I like, because these are the ones that get through regulators. These are the ones that go through very easily. Now, Microsoft declared a 62-cent dividend over the week. We got about a forward yield of about 1% over on Microsoft. They typically raise that dividend every year. Moving on to Tesla, started the week at $667 per share, down about 2.5% to $650 per share. This is after Elon Musk or in this case, Tesla, raised the price across most of their car models in the US, including the Model Y Long Range Edition, up to $65,990. This is when the car cost $62,000. I think when I reserved mine, it was the mid 50s. I looked at my all-in cost for my Model Y. I just bought one of these Model Y Long Ranges 2 or 3 weeks ago, and my all-in cost after all the taxes and the fees, and trust me, out here in California, they tax and fee you for everything. My all-in cost for that car is actually less than $65,000. I could have picked that car up and sold it literally the next day and made a small amount of money again after I paid the state of California probably plenty of taxes and fees. This is just a sign that this company has one pricing power, because we're starting to see the delivery dates on a lot of these cars continuing to get pushed back and pushed back. Although again, anecdotally, my Model Y Long Range was not supposed to be delivered until November, but it was delivered obviously last month. Now, Tesla filed for a 3-for-1 stock split. This news hit just as we were recording last week. Obviously, as we saw with this case, and we say it all the time here on the channel, these stock splits in the shorter term might be good for the headlines, but look, the stock was actually down 2.5%. Again, this is on the heels of last Friday announcing this 3-for-1 split. What this does, I would say probably the only thing that this does is it makes the options even cheaper, because obviously the options premium on a $650 stock, also, you know, if you're trying to do covered calls or something like that, to own 100 shares of Tesla at $650 per share, obviously a very significant amount of money. Well, a 3-for-1 split cuts that price down even more, and then obviously cuts the options contracts that you have to pay. So I tell you what, if you like shorter term volatility, and Tesla certainly has that, well, obviously the options in Tesla, very attractive. Now, moving over to the technical segment of the program, and I want to remind everybody, this is the technical segment of the show. I have a lot of people say, well, they're offended by this volume profile and the fact that these stocks or these markets can go down another 20, 30, 40%. And this is what this volume profile, good guys, I would do you absolutely no justice as somebody that comes on here and spouts financial quote unquote advice to tell you what I think. So the technical segment of the program, I'm telling you what the chart is telling you, and you decide whether or not you believe it or not. Now, the S&P 500 right now, like a lot of these stocks, just in this mega downward channel, and we are way down here. I mean, we are talking way down here at below and at the bottom of the channel. We have to expect at some point some big gigantic green move, and it doesn't necessarily have to be gigantic, but we'd expect this market to move back up into this range, probably bringing the S&P 500 index back up over maybe 3,900, 4,000 on this one. That is what we are expecting as investors. You get this type of rally, I think you can take profits. If you want to play the short side, the more and more it goes up, well, I tell you what, the more and more that trade seems like a really good setup. For this move to be essentially a technical break of this downtrend, boy, it'd have to be a hell of a move. I mean, we're talking about 20, 30% rises in these index, which again, over the course of maybe 2 or 3 months, just doesn't seem necessarily likely. Although if it happens, we'll certainly change our strategy. I think the other thing that could happen that is slightly less likely, again, I think the probable outcome with this market and most of these stocks is next week and into the following week, basically as we melt into earnings. We're about a month away from earnings on all companies. I think it's possible the markets kind of melt up into those. That's probably our kind of base case. The other scenario is the market just takes a big dump, and instead of getting back in the channel, it just essentially the bottom falls out. That is kind of what we're hoping for. Okay, if you're retired or you're over leveraged in your stock account, well, I'm sorry, you should have made some adjustments already. I mean, this is the clearest downtrend and topping pattern we've ever seen in the stock market in ages, but would be very interesting for long portfolio, long retirement type investors. If we just get a big crap out in this market, if you see something like that, I think it's absolutely 110% a buying opportunity, because that would be completely different than what we are seeing. Again, Meta platform, very similar type setup to the S&P 500, except we've got volume profile. This is where we'd expect Meta stock to start bottoming out, right here in the 160s. Certainly when you look at this from a valuation perspective, even if you pull earnings in a ton, pull sales in, say they go to negative like 4 or 5% sales growth for Meta next year, which I don't necessarily think is that crazy of a thing. Well, the multiple on sales and earnings over at Meta, certainly cash flows as well. And then we're seeing all these press releases with Meta as well, that they're cutting costs. They're going after Sheryl Sandberg for, private flights and her wedding and all these types of things. Well, they're belt tightening over at Facebook. I would expect their earnings actually to be somewhat decent. And that's what we're seeing with the volume on the stock. People are stepping in at this level, and we are at the bottom of this channel with Meta. And it's just been an absolute predictable pattern by this stock since it had that mega drop after earnings. I recommended getting out of this stock at $220 per share. You had a chance here, you had a chance here, you had a chance here, you had a chance here. You had 3 or 4 opportunities to get out of this stock at $220 per share, which I was like, get the heck out of this name. And now here it is at 160. This can be a buying opportunity down here at Meta, because again, what we are expecting with this stock and most stocks is some kind of rally off the bottom, and the rally could be super hard with Meta. You could go from 160 comfortably back up to very close to $200 per share, and you're still technically in this downtrend. We technically expect the stock to react negatively after that. Again, technical chart patterns are just that. It's a pattern. Meta is making this downward trend line pattern, and if that continues, we should get a hard rally to 200. That is your area to sell. And again, the rallies don't always get there. Sometimes they could crap out at 180, 190. That is why I'm trailing stopping. If I'm playing Meta in this bounce up, I am setting a trailing stop on this one. So as it moves up, my stop just gets moved up. And if this one reverses trend, well, I get out of that one. Now, the very, very, very negative and bearish move Meta could make, just like the S&P 500, is crap out below not only this downward trend line, but crap through the volume profile. You get a move south of $150 per share on Meta, and I will be, not you, I will be the first one to buy a stock like that, because that would be absolutely like a 2 or 3 standard deviation move that you just simply don't see very often. That would be an absolutely fantastic buying opportunity, in my opinion. Moving on to Apple, very much like Facebook, this thing is locked in this downward trend. We're at the bottom of this channel. We would expect this one to bounce up, back up in here to about $150 per share, only to get rejected and move back. The negative move would crap this stock down south of $120 per share. We're currently sitting at about $131 per share on Apple. I certainly think you could accumulate shares at that price, but based on this negative momentum in this trend in this market and in these names, well, I tell you what, I think you're going to get an opportunity south of 120 on Apple, and I would take it at some point at that time. Now, moving on to Amazon, pulling into this kind of green box that we've had marked out for a while here with Amazon, south of about $100 per share, anywhere between about $80 and $100 per share, I think is where you're going to see a lot of accumulation. Now, sometimes everybody is looking at all the same charts, all the same technical patterns, all the same data. So sometimes people will jump the gun. I don't necessarily think that's the case with Amazon. This stock is just kind of hovering at $100. I think it's a little bit of a psychological level. I think this stock breaks through this level at some point. You get it south of $100 per share. I really like this. If you don't want to pinch pennies or split pennies, or you're not really concerned about it, well, you certainly can come in here at $100 per share. Wouldn't necessarily be aggressive, because I think the bottom with this one is another 10 to 20% lower, and that's probably across the board on most of this stock. The downside is probably not much more than 10 to 20%, although some of these technical chart patterns would have you believe otherwise. Moving on to Netflix. With Netflix, it's a little bit different than all these other stocks. The volume profile, when you have this kind of big gap, well, it's actually up here. It's above the stock. That's why if you get any kind of momentum in stock markets, that's also why when the markets kind of go up, Netflix is going up a little bit higher than the other ones because simply there's just not that many sellers down here. But clearly, there's not enough buyers as well. This stock is just kind of channeling down. We'd expect, actually, this one's kind of towards the top of the channel. If you do get a rally in markets next week and you get most of the stocks, including Netflix, participating in it, well, it could actually break out above this channel again. You'd like to see this one get above $200 per share. If you do, that would make an interesting technical formation where I think you're looking at maybe now the floor being down here about where the stock is trading at about $170 per share. Again, let the chart, let the formation of the pattern kind of tell you this, but that is potentially in the cards next week. Now, probably more expectantly with Netflix and most of these stocks is they make maybe a smaller move. Netflix really doesn't have a lot of room to move to the upside before you come back down here and retest the bottom of the channel. Netflix is an interesting setup. It's already at the top of the channel, whereas Meta and Apple and Amazon are kind of towards the bottom end of the channel. We'll see how that materializes into next week. Moving on to NVIDIA. This one is pulled into our green box as well. We have that marked out basically south of $160 per share, between $115 and $160. I like this one. I accumulated a couple of shares this week inside my IRA account. This was an opening position, probably a 10% buy. So as this one, again, from a technical chart pattern, this one looks like it just wants to hug this red line. We'd expect it to pull back into this 140, 120 range. That's when I'd probably be a little more aggressive buying that one. Moving on to Google, also sitting on top of the range, looks very much like Amazon. We have marked out here south of $2,000 per share on Google. Looks really good. But again, everybody is looking at this as well. And so I would never blame someone for just nibbling at these areas. Again, we're kind of at the bottom of a range. I think at some point, what I am not expecting with most of these stocks is some kind of V-shaped recovery where all of a sudden the all clear sign is waved by Jerome Powell and gas goes down to $2 a gallon and everybody just feels good about themselves. Well, if that were to happen, well, yeah, these stocks would V-shape in this green fashion and get all the way back to all-time highs and probably above them. I don't necessarily see a scenario where that plays out in the shorter term. I think what far is more likely is we eventually start chopping sideways with a lot of these stocks where you're not really going up, but you're not going down in a steep fashion. That is when I think we'll do a lot of the accumulation. So a lot of you asking, what's my top 5 stocks? What am I trying to buy? I'm waiting for something like this to show up. Look, if we have a V-shaped recovery in these markets, just like we have March in 2020, will I miss some of the upside? Sure, but I haven't sold my Google stock. I haven't sold my Amazon stock. I haven't sold my Apple stock. I haven't sold my Microsoft stock. I have plenty of upside if the markets end up doing that. I think far more likely is eventually you'll break out of this downward channel. People will say the end is near. There'll be another red candle, but the next red candle doesn't take us below and makes new sets of lows, and we start chopping sideways. That is when I love accumulating stocks. And I think that opportunity is coming in the coming weeks and months ahead. Obviously, keep you abreast of that here on the channel. Now, Microsoft down at the bottom of the channel. We'll zoom in on this one a little bit because I do want you to see we're at the bottom of the channel with Microsoft. So next week, we're looking for some kind of rally probably to the top of the channel. What I did is I compressed Microsoft channel because it started to fade out when it got to the middle. You could technically push this all the way up here. So Microsoft, if the broader market has a really strong week, you could go from 250 back up over 280 on Microsoft as soon as next week and maybe the weeks after. I think far more likely is you fade out here into the 270 range and then you put up another red candle and you come down here south of your previous lows, which are down here about 240. There is some layer of support with Microsoft south of about 230. I am anticipating this stock making this move into this sideways consolidation, essentially taking it to the top of the pre-pandemic kind of drawdown and then run up. Most stocks are kind of basically giving back that whole gain. Wouldn't surprise me if Microsoft does that. That would be right about $190 per share. I think investors would jump the gun a little bit on that one, closer to about $210, $200 per share. That's really where I'd like to just put another stamp on my Microsoft shares and just kind of unload quite a bit at that level. Again, that's another $30 to $40 lower than where the stock is right now, which would be a pretty significant move. If you get this big red candle, I'm just letting you guys know, if you get this big red candle next week or the following week, this I think is a candle you buy. The news, everything is going to be so ugly because from a technical perspective, it is going to be a complete wipeout of the downtrend. But I think that could be the final washout, is these downward trends on all these stocks, other than probably Netflix and Meta, has been really orderly, okay? What you're looking for is just that last kind of washout slam down. And if we get that red candle, I think you'd be incredibly more aggressive than we have been over the last couple of months as these markets have sold off. Now, finally, moving on to Tesla. This one, just like most of these stocks, is at the bottom of the range. We'd expect with Tesla to move back to the top of this range, which would be a hell of a move on Tesla. I mean, if you get to the top of this range, again, not superseding the previous highs, which essentially means this downward trend is intact. Now, if you put up a big green candle, you get up over 1,100, basically, but you have to get near all-time highs of $1,200 per share on Tesla to basically mean this move is over. And look, some of you might say that might happen. Don't worry, because guess what? The high probability, if Tesla does that, if it puts up highs up here at 1,200, well, it's going to have a nice little pullback. It'll probably pull back and retest this downward trend line, and you'll get another opportunity there. And some of you might say, well, why don't I just buy it here at 650? And if it goes to 12, well, guess what, guys? The higher probability, that is a very low probability. Tesla going to 1,200 in the next 2 or 3 weeks is such a low probability. We don't need to even open up the options chain, which basically shows what a low probability that is. The higher probability with this stock and almost all of these stocks is they put up new lower lows in the coming weeks ahead. As we move into earnings season, investors will probably be a little bit more cautious than they are aggressive with these stocks. It's possible. Investors decide to throw in the towel before earnings, which again are a month away. And so investors might be like, I don't want to own any of this stuff heading into earnings. That could create a big red down candle event. That could push this stock down south of $500 per share. You get a big red candle in this name. That also proves to be, I think, a once in a decade type buying opportunity with this type of stock, along with Microsoft, Apple, Amazon, and Google. Hopefully you guys enjoyed today's video. Have a wonderful weekend. We'll see you again next week. Good luck with your investments.